The exam will be like for the midterm, like the
Yeah, yeah.
figure and explain
Yes,
it.
yes. And I will ask you one maybe application regarding to the Keynesian economics.
Okay.
Okay.
Thank you.
Okay.
Thank you.
You're welcome. Okay, let me present the file. Okay, you see the slides, I think, the PowerPoints.
Yes, I see it.
Okay. As I said to you, I'm going to present you the central bank instruments for controlling the money supply and the money market, monetary activities in the market, in the financial system will be introduced to you. How it is controlling and managing the monetary policy is going to be introduced. Uh, the Federal Reserve System actually is the central bank of America, of United States, and we are trying to understand the relationship between interest rate, money supply, and maybe the inflation, because inflation is also related to the interest rate. And regarding to this enlargement in the market, as you know, if the money supply is enlarged in the market, then the inflation is in the subject, and when the inflation is increased, then it is expected that the nominal interest rate is also enlarged and increased. And since I remembered I have introduced in the
Sam,
beginning, yes, please.
I can't see the slide.
Ah, you can see the slides. I will quit, stop the sharing, and try to uh, do it again. Ah, okay. What about now?
I see it now.
Okay. Uh, as I said to you, the money supply is directly related with the inflation, interest rate, nominal interest rate. And from this point of view, if the money supply is enlarged and become too much in the circulation, this will then cause some inflation. The inflation will become higher. And when the inflation is going to up, the nominal interest rate is also up, increased. And since we know the Fisher equation, which is directly related with the real interest rate, which should be equal to the nominal interest rate minus inflation, or the nominal interest rate should be um, becomes zero, at least for balancing the real interest rate, for not losing the value of the reserved amount of money in the system. The learning objectives for this chapter, we will then introduce you, as I said to you, the monetary policies and the instruments, the how the monetary market is affecting and changing the market, and we will summarize how the conventional monetary policy tools are implemented and the advantages and limitations of each tools, as open market operation, reserve requirement, and discount rate will be then introduced to you. And then we will introduce the key monetary policy tools regarding to this direction, of which I have mentioned, this open market operation, discount rate, and reserve requirements. And then we will identify the distinctions and similarities between the monetary policy tools of the central bank, and then gives you some shifts on the market when the supply and demand, or the interest rate is going up and down, how it is managing and affecting the market structure will becomes in question. The demand and supply in the market for reserves is also important, as much as the interest rate going up, the amount of the money which is saved and which is demanded, so-called borrowed, is affected. When the interest rate is up, we are expecting that the amount of the supplier or the amount of the savers will enlarge, because when the interest rate which is given for the amount of the money for the savers is larger and higher, then people enjoy to put some money to the bank because they will profit at the end of the period. And for the demander, for the borrowers, this is opposite. When the demand is high, when the interest rate is high, the demand of the money or the borrowing capacity for the loanable fund will become reduced. And this is how it is affecting and changing the market structure is in question. What happens to the quantity of reserve demanded by banks, holding everything else constant in ceteris paribus as the federal funds rate changes? Since the fall of 2008, the Fed, so-called the Central Bank of America, has paid interest on reserves. The level is set at a fixed amount below the federal funds rate, and it is targeted to the interest rate on reserves will then become smaller or become equal to the interest rate for the federal funds rate. The excess reserve are insurance against deposit outflows. The opportunity cost of holding this equals the differences between the interest rate for the federal fund reserves to the interest rate on reserves. The demand curve for reserves slopes downward when the interest rates for the federal fund rate is above on the interest rate on reserves, and it becomes flat, infinitely elastic at that level where the interest rate on reserve is subjected. When the federal fund rate is above the rate paid on excess reserves, the interest rate on reserves, the federal fund rate decreases and the opportunity cost of holding excess reserves falls and the quantity of reserves demanded increases. And when interest rate for federal fund rate falls below the interest rate on reserves, banks keep on adding their holdings of excess reserves indefinitely. The supply in the market for reserves, two components we are considering here, as I mentioned, non-borrowed and the borrowed reserves. And cost of borrowing from the Federal Reserve System is the discount rate, which is very popularly used as a monetary policy. And borrowing from the Federal Reserve System is a substitute for borrowing from other banks. If the interest rate for federal fund rate is less than the interest rate for discount rate, then the bank will not borrow from the Federal Reserve System and borrow reserves are zero. And the supply curve will be vertical. As interest rate for Federal Reserve rate rises above the interest rate for the discount rate, banks will borrow more and more at the interest rate for discount rate and the relent at interest rate for Federal Reserve federal fund rate. The supply curve is horizontal, perfectly elastic at interest rate for the discount. The graph is illustrated here, the equilibrium where the markets for the reserves is illustrated, and when the interest rate, federal fund rate, is less than for the discount rate, the quantity of reserve demanded equals the quantity of non-borrowed reserves. As you see, the excess demand for reserves is represented on the investor-related graph or figure or the line, which is investor related between the federal fund rate and the quantity of reserves. And the excess supply curve, which is vertical and parallel to the fund rate, is the excess supply of reserves. The fund rate falls to up to the, let's say, interest rate to the federal fund rate. I'm going to enlarge it because it is a little bit smaller, then you will see better. You are probably seeing better, isn't it now?
No, I don't.
You don't see. Oh. When I am enlarging it, you don't see. Probably you will see now. or
Now
still
I
not?
see.
Okay. Now I'm going to the next slide. If you don't see, then please remind me. You are seeing the slides?
Yes.
Okay. How conduct of open market operations affect the federal funds rates? Open market purchases or sales shift the supply curve to the right or to the left. And the effect of an open market operation depends on whether the supply curve initially intersects the demand curve in its downward slope section versus its flat section. And open market purchases causes the federal fund rate to the fall, whereas an open market sale causes the federal fund rate to rise when intersection occurs at the downward sloped section. Open market operations have no effect on the federal funds rate when intersection occurs at the flat section of the demand curve. Now we are going to see on the graph this. The response to the open market operation, as I mentioned to you in the former lectures also, I have also mentioned, the open market operation can be expansionary money policy or contractionary money policy. Here we are questioning how it is affecting and changing the reserve ratio. The supply curve on the left side initially intersect demand curve in its downward sloping section. As you see, the demand curve is the inverse related to the federal fund rate and the quantity of reserves, also called the loanable funds. And the supply is a vertical blue line, which is shifted then to the green on the graph. And open market purchases shifted demand. Yes, please.
I don't see the slash you are explaining.
Okay, then I have to smaller this. I have to turn back to the former slides. Then you will see probably
Okay.
now. You see
Okay.
now. You are
Yes.
seeing because when it
Yes.
is enlarged, then it is difficult to translate probably or transfer to your screen. But you are seeing, isn't it now?
Yes.
Okay. I will enlarge it a little bit. What about now? It's better. You are
Yes.
seeing, isn't it? Okay. As I said to you, an open market purchases shift the supply curve to the right. As you are observing, the right red line, the vertical red line is shifted down because the federal fund rate is reduced. And when this is reduced, as I mentioned to you, the supply is expected to enlarge. Results of these shifts in the interest rate. And this federal fund rate, when it is go down, it is expected to enlarge and increase the supply of this and becomes a little bit larger and shift this to the red vertical line. And on the right side, the supply curve initially intersected demand curve in its flat section. And as you see here, the open market purchases shift the supply curve to the right again. But the federal fund rate cannot fall below the interest rate paid on reserves because it is expected that the market structure is not easily affected from these changes and it is stay intact. As you see, the fund rate stay intact when the supply curve shifted to the right. How changes in the discount rate affect the federal fund rate? If the intersection of supply curve and demand curve occurs on the vertical section of the supply curve, a change in the discount rate will have no effect on the federal fund rate. If the intersection of supply and demand occurs on the horizontal section of the supply curve, whereas the federal fund rate is equal to the discount rate, a fall in the discount rate shifts the portion of the supply curve downward. Hence, the federal fund rate falls and borrowed reserve increased. Now we have the response to these changes in the discount rate. We are considering now the discount, which is very popular, also used, let's say, monetary policy in the central bank. And on the left side, we suppose no discount lending is realized and it is supposed to be zero. And on the right side, some discount lending is occurred, and it is a little bit higher than 0. And when you are looking to the graph, the lowering discount rate shifts the supply curve to the down as you are observing the discount rate is shifted from 1 to 2 on the federal fund rates, and results of this, the expected supply curve is reduced as you are observing, but this does not affect and not lower the federal fund rate, as it is becomes somehow in the same equilibrium position with the supply and demand curves intersect at point 1, because this lowering discount rate is not easily affecting the federal fund rate. It is only affecting the amount of the money in the system, because lowering the discount rate is somehow reducing the interest or the banking interest, and they will then employ or demand more, because it will become cheaper, because this, when the central bank reduces its discount rate, then people or the below banking sectors or the departments or the institutions or intermediaries will enjoy to get this with these lower rates and enlarge it and increase it in the market. And results of this then will becomes a little bit lower, as you are observing shifts from R1 to R2. And on the right side, the lowering discount rate shifts the supply curve when it is below the equilibrium supposed to be. Shift the supply curve to down, as you are observing, and now because it is below the federal funds rate, will become affected, and this will then shift the federal funds rate also to the lower level, and the supply and demand or saving and borrowing of capital will become affected and shifted again to the downward, as much as this discount rate decreasing to the ID1 to ID2. Similarly, the interest rate for the federal fund rate will become also reduced at the same level or at the same amount, and becomes to the equilibrium at point 2. How changes in the reserve requirement affect the federal fund rates? When the the Central Bank of America raises reserve requirement, this is the another instrument of the central bank. We have discount rate, as I said to you, we have the open market and the reserve requirement. The federal funds rate rises, and when the Fed decreases reserve requirement, the Fed funds rate falls. It is normal, because fund raise, the reserve requirements is affected, because if you increase the reserve requirements, then the banking sector will then increase their rates to hold the money in the sector, and results of this, the amount of the money will become enlarged, and vice versa, opposite, when decrease reserve requirement, the federal fund rates will also fall, because it is not necessary to hold that much money in the bank. They can use for the other purposes. Here, the reserve requirement is illustrated on the graph. The fund rate on the y-axis, and the quantity of reserve is again on the x-axis. And increasing the reserve requirement, as I mentioned to you, causes the demand curve to shift to the right. And as you are observing, results of this shifts, the demand will enlarge and increase, and the federal fund rates will also rise and shift, and the federal fund rate will become higher position, and the supply and demand of this curve will become again in equilibrium at higher points, where the red line intersect the vertical supply or borrowing line on the graph. How changes in interest rates on reserve affects the federal fund rates? The intersection occurs on the demand curves, downward sloping section. A rise in the interest rate on reserve does not cause changes in the federal fund rates. If the supply curve intersects the demand curve on its flat section, a rise in the interest rate on reserves rises the federal fund rate. Therefore, this is very important to know. This monetary policy is heavily affecting and changing the market structure and trying to balance and creating some sustainable structure for the money policy, for the monetary amount in the market. This is very important to know. We will have then stable and not too stagnating economical structure results of these policies. And the role of the central bank and the policies will become very eligible and will become very important for controlling the money supply in the system, which is very important for having stable currency or no domestic currency in the system. The response to the change in the interest rate on reserve is given here. Here it is, as you are observing on the right side, the initial federal fund rate is supposed to become a little bit larger than the interest rate on reserves. And on the right side, it has become equal. And on the graph, we are seeing a rise in the interest rate on reserves from I1 to I2 for the interest rate on reserves. You are observing it is not affecting and letting the federal fund rate unchanged, as you are observing, because it is a little bit lower. And when this is realized, where the federal fund rate is almost intersect the uh, supply and demand at lower level, and the uh, interest rate on reserves is somehow shifted to the higher level. Now the interest rate for the federal funds is becoming affected and shifted again to the upper level, and a rise in the interest rate on reserves from let's say 1 to I2, then affecting the interest rate for federal fund rates and shifted to the upper level again, because the initial federal fund rate is supposed to be equal to the initial interest rate on reserves. And on the right side, it is on the left side, sorry, it is observed the initial federal fund rate is becoming larger than the initial interest rate on reserves, and results of this, it is not affected because it is a little bit lower, as you see in the left graph on the left side of the figure on the graph, and on the right side it is becoming equal. And how the Federal Reserve's operating procedures limit fluctuations in the federal fund rates is then in the subject. Supply and demand analysis of the market for reserves illustrates how an important advantage of the Fed's or the central bank's current procedures for operating the discount window and paying interest on reserves is that they limit fluctuations in the federal fund rate. On the graph, we are seeing the important effects of these limitations for the fluctuation in the federal fund rates. And a rightward shifts of the demand curve rises the federal fund rates to maximum of the discount rate, as you see on the right side, and shift it to the right. And on the left side, the leftward shift of the demand curve lowers the federal funds rate to a minimum of the interest rate on reserves. And as you see on the right side of the graph, of the same graph, the initial federal fund rate becomes similar or equal to the discount rate, and it is then shifted to the right. And on the lower part of the graph, which is dotted line is illustrated with the green, with the red one, the discount rate now is becoming, the initial federal fund rate is becoming intersect each other, as you see on the RD and RS, where the supply and demand of this money market with these reserve requirements, and reserve market is in the equilibrium. On the lower part of the left side, we are observing the initial federal fund rate is becoming equal to the initial interest rate on reserve. The conventional monetary policy tools can be illustrated as you are observing on the graph, which we presented. During normal times, the Federal Reserve uses three tools: the monetary policies mentioned and illustrated and presented to you, the open market operation, discount rate, and reserve requirements. As I mentioned to you, open market operation is the expansionary money policy and contractionary money policy. Discount rate is somehow similar to the interest rate, is affecting and changing the market. And reserve requirement is the set of the interest rate of the central bank for holding a certain amount of money in the money market, for controlling the money market and monetary amount in the circulation, for maintaining sustainable economy policy and money policy. This is then, of course, as I mentioned to you, is done for controlling the money supply and the interest rate and also the inflation in the market. And when you are under control these three instruments and these three variables, then you may become more sustainable or more strong currency in the market, and it is good for the country's profile and performance in the international market. This is somehow the conventional monetary policy tools, which is usually used by every country. The open market operation, the dynamic open market operation, intended to change reserves and monetary base. And defensive open market operation, repurchase agreements, so-called repo, and much sale purchases agreement, the reserve repo. And primary dealers is also subjected. The TRAPS open market operations are conducted electronically with dealers in government securities known as primary dealers by the computer system called TRAPS. The monetary TRAPS is very popular also, but we are going to introduce you only the let's say, the tools which we are using in the money market. The discount policy and the lender of the last resort is the, as you know, lender of the last resort is the central bank, and it is very heavily affecting the economy. And if these policy instruments, as I mentioned to you, this open market operation, discount rate and reserve requirements, perfectly applied and control the money supply in the system, then the economy is doing well. The discount window, there are three types of fit discount loans to banks. Are you listening me? Do you have any question? If you do have any questions. Okay. The primary credit standing lending facilities, healthy banks are allowed to borrow all they want at very short maturities, and it is set usually 1 percentage point higher than the federal funds rate target. And secondary credits and seasonal credits are also available, and the lender of the last resort, as the central bank, is the highest organ in the money market, in the financial market, for knocking the door and knocking the let's say, for getting some bailout for your crisis, for economical or financial crisis or financial problems, is expected to hold the sufficient currency and let's say resources and loanable funds in the hand for being able to help for those let's say intermediaries who are in need, who are holding some problems in their institution. The reserve requirements, depository institutions, the Regulation and Monetary Control Act in 1980 set the reserve requirements the same for all depository institutions. The reserve requirements, as I mentioned to you, is very important for the central bank for controlling the amount of the money which is holding by the institutions and intermediaries in the banking sectors. And if it is set very high, then this will then secure the problems. But if it is set too high, too much, it will be increased too much and too high level of reserve requirement or rate is set. Then this will then create problem because they will not have ability to use this collected amount of loanable funds for making some activities, economic or other activities, for enlarging and increasing the amount of the money in the banking sector. And reserve requirements are equal to 0 for the first, let's say, 15.5 million of banks checkable deposits, 3% on checkable deposits for 15.5 to 115.1 million, and 10% on checkable deposits over 115.1 million. As I said to you, these reserve requirements can be between 10 to 15, and it is the best possible percentages for using this reserve requirements for in just cases you are in need, or some intermediaries or institutions are in need or need some bailout, for being able to help and support them for rescuing this unexpected crisis or financial inability or problems. The Fed started paying interest on excess reserves only in 2008, and it is used to provide a floor under the federal funds rate. The interest rate on excess reserve tools came to the rescue during the crash, as banks were accumulating huge quantities of excess reserves because it can be used to raise the federal funds rates. As mentioned to you, this is important to hold, but if it is too much, then it will create problem to the whole system. Therefore, the expected percentages must be preserved and hold. Not too much, not less. This is how it is going to be maintained for sustainable economy and monetary policy. The relative advantage of the different monetary policy tools. As I said to you, the open market operations, the expansionary money policy, contractionary money policy are the most important two instruments for controlling the amount of the money in the circulation, are the dominant policy tool of the central bank, since it has complete control over the volume of the transactions and the liquidity circulating in the system. And these two expansionary and contractionary operations are flexible and precise and easily reversed and can be quickly implemented. Expansionary money policy is used when there is some supply side effect and limit the amount of the money in the system to enlarge and increase the amount of the money, and contractionary money policy when there is excessive money supply in the system and you want to reduce the amount of the money, then in this case you will buy. You will sell some securities to buy this amount of this excessive supply in the system. In the expansionary, you will enlarge it by selling some securities. You will contractionary reduce it. This is how it is realized. When you have expansionary money policy, this means you are going to buy some securities and pump up the money to the system, and vice versa for contractionary. The discount rate is less valued since it is no longer being binding for most banks, can use liquidity problem and increase uncertainty for banks. The discount windows remains of tremendous value given its ability to allow the Fed or central bank to act as lender of the last resort, which is the highest organ, as I said to you, in the financial system. On the failure of conventional monetary policy tools in a financial panic, when the economy experiences a full-scale financial crisis, as I mentioned to you, the bankrupt or any bailout program is required. Conventional monetary policy tools cannot do the job for two reasons. First, the financial system sizes up to such an extent that it becomes unable to allocate capital to productive uses, and so investment spending and the economy collapse. Second, the negative shock to the economy can lead to a zero lower bound problem. This is how it is. So it is very difficult issue for maintaining these policies if the expected reasons or mentioned reasons is in the market. The non-conventional monetary policy tools during the global financial crisis, the liquidity provision, Federal Reserve implemented unprecedented increases in its lending facilities to provide liquidity to the financial markets, discount window expansion, term auction facility, new lending programs, large-scale asset purchases. During the crisis, the Fed started 3 new asset purchase programs to lower interest rate for particular types of credit. These are government-sponsored entities purchase program, QE2 or QE3 program, which is subjected for reducing the amount of the money or enlarging and becoming some let's say relaxation in the crisis. The expansion of the federal bonds balance sheet is given here, where the let's say the central bank of the America try to remove or reduce this crisis in 2008. If you remember the Lehman Brothers, it was a crisis in the United States, and during this period of time, it was a heavily program applied for maintaining a sustainable economy and financial monetary policy, because this crisis, this financial crisis expanded to the whole world, because since the dollar is the international currency, it is becoming very heavily affected and changed the whole system. The traditional security holdings is given on the yellow one, or so-called the light brown, and long-term treasury purchases is represented with the dark brown. The lending is represented with the light blue, sorry, and the Fed agents debt and mortgage-backed security programs is represented with the little bit heavily blue, or let's say some purple colored. As you see, during this period of time from 2008 to 2014, this is affected and changed the whole system, the whole financial securities in the market. The non-conventional monetary policy tools during the global financial crisis, as I mentioned, quantitative easing or monetary easing is somehow, instead of printing money, you are using some Fed policies, especially the expansionary money policy or contractionary money policy, for enlarging it. Here, the quantitative easing means you are enlarging the amount of the money, which is expansionary money policy. Fed's policies were directed not at expanding the Fed's balance sheets, but rather a credit easing. As I said to you, this is somehow using some, let's say, securities, bond, and some other papers, stock markets, will be then distributed to the market for pumping up some money to the system. This is how it is realized. Either or, you are going to balance the economy with this quantitative easing instead of printing money, because printing money is not good for the economy. This will create high inflation and cause too much to the financial stability, and cause some stagnation in the economy. And this is altering the composition of the federal balance sheets in order to improve the functioning of particular segments of the credit markets. As I said, to the credit easing or the quantitative easing, how it is realized, I mentioned to you the forward guidance. By committing to the future policy action of keeping the federal funds rate at zero for an extended period, the Fed could lower the market expectations, because when you are increasing the interest rate, this will also cause some, let's say, problem to the economy. And since you are exercising some credit problems, some let's say monetary difficulties, then it is expected that you lower the interest rate and you enlarge the amount of the money supply in the system. This is almost similar to the quantitative easing. In the quantitative easing, you are using some securities, some bond and stock markets, but in the forward guidance, it is similarly use some other issues for short-term interest rating, bringing down to enlarge the amount of the money. But when you are downing this interest rate, this will also affect the inflation. And instead of using this issue, it is better to use the quantitative easing for balancing the economy. Otherwise, when you are using such policies, this will affect the economical parameters. Therefore, quantitative easing is better expected to use instead of playing with the interest rate. And in the economics, we don't prefer to use this interest rate issue heavily for controlling the money market. Instead of this, we are using some securities because the stock market and bond market is heavily affecting and controlling also money. And when you are increasing the price of these papers, it is expected that you have to reduce the interest rate or vice versa. Therefore, if both is down, then this is problem, because when you reduce the paper market price and similarly at the same time you reduce the interest rate to zero, this is the problem to the whole economy. Therefore, you have to know that when you use the paper market prices go down, then you can reduce the interest rate, or vice versa. When you increase the interest rate, you can down the securities, so-called the paper market, bond and stock market prices. Then you can balance the economy by using this, let's say, securities and papers in the market or instruments for controlling the economy. The negative interest rate on banking deposits. Setting negative interest rate on banks deposits is supposed to work to stimulate the economy by encouraging banks to lend out the deposits they were keeping at the central bank, thereby encouraging households and businesses to spend more. However, there are doubts the negative interest rate on deposits will have intended expansionary policy or monetary policy effect. Therefore, negative interest rate is used in some developed, very highly developed nations where they are holding too much in their let's say loanable fund market, and they don't need this, and they are using this negative interest rate for enlarging the market, for using enlargely the money and for circulating the money in the system. But in fact, this will then cause sometimes too much to increase the inflation and reduce the stability in the market. Open market operations, sorry, main refinancing operations, weekly reverse transactions, long-term refinancing operations, lending to banks, marginal lending facility, marginal lending interest rate, and deposit facilities and reserve requirements. As I mentioned to you, 2% of the total amount of the checking deposits and the other short-term deposits can be used, or some pays to the interest on those deposits, so cost of complying is low, is expected. This is how it is in the open market operations and in the reserve requirements realized. I think this was the today's presentation. I have done the all, I think, and if we had another week, I would present you some other instruments and some other policy application and effects to the whole EU market, the so-called the European Central Bank, and some other impact to the, let's say, small countries, large countries. Comparison will be given to you or would be given to you. But unfortunately, we have come to the last part of our presentation. And I think this will be the last class before final exam. If you have any question, you don't hesitate to ask me or write me email. If you know my mail, you write me. It is, I think, given to you, aeakalpler@gmail.com. You can write me any email or any question, or you can communicate with me if you have my WhatsApp number. that's what how I'm going to help you, or you may come to my office next week. I will be in the office on Monday, Tuesday, and Thursday. On Friday also, you will ask me whatever you need. Do you have any question, Kevin and Annie? I think Said today didn't able to attend.
I don't have question, but I
Okay.
want to know which part of
Yeah.
course we have to start for the final exam.
I will upload the system to the queues materials, and you have to read also the midterm stuff also, because these are all combined. If I am saying you don't read this, then you will not understand probably the second semester, second part of the after the midterm. Therefore, you have to read this also for being able to become familiar to the aggregate demand, aggregate supply, the Keynesian economics, the marginal propensities. You have to learn all stuff for being able to, because you are master class, and if you are able to learn the before midterm stuff, this will help you to understand the second part of the lectures easily. As I said to you, you don't have to worry about your exam. I try to treat you as much as possible fairly for giving you the best possible result, because you are dedicated. As I observe, you are trying to learn. I appreciate. And if after you are doing your assignment, this will also help you to upgrade your results regarding to your performance after you attended to the final exam. I will definitely use my own contribution for helping you. Okay, if you do have any
Thank you,
question, you
sir.
will ask me. If you don't, then as I said to you, I will upload to the queues the materials. Please read them, and if you have any question, don't hesitate to ask me or communicate me. Okay? Said, I suppose you didn't attend today class, but Kevin today attended, and I uploaded the assignments. If you have downloaded, you probably seen you saw, I think, the assignment, isn't it? I
Yes,
wrote the
I've seen it.
names
Yeah,
for the each.
sorry
Okay,
that
then.
I came a little bit late today because I had interview with Uncle Sam's, and I came a little bit late to the home. And also, I already download the assignment. There is no problem with it. I'll
Okay.
do my homework assignment, and I'll give it to
Okay.
you on the exam day.
Okay. You can submit to me either my email address, or you can print it and deliver me to the hard copy to the final exam. Okay, no problem. It will be your preferences. And as I said to you, I'm going to upload the missing presentations today, PowerPoints also to the queues, and you can download and read the stuff for your exam. Okay.
Okay, sir.
Thank you very much for your attendance. I hope you will successfully finish this semester, and we
Yeah.
will see you next semester probably again. Okay. Thank you.
Okay.
Have a nice
Thank you
weekend. Bye
so much.
bye.
I appreciate all
Bye
your
bye.
effort because of us. Bye bye.
Thank you very much. Bye bye.
Oh, bye bye.